2022 so far has been a rough year for the global economy, from Sri Lanka, where consumer prices surged a whopping 29.8% in April from a year earlier, to Germany, which is dealing with soaring energy prices, something they have never seen before. And of course, no one can discount what's happening in Turkey, which now has an annual inflation rate at nearly 70%. In America, we're seeing the economy contract severely in almost every aspect.
On GDP, but do you think we're going to see a recession?
I think the chances are at least 50-50 that we'll see a recession over the next year.
We're at the early stages of a very significant synchronized global recession.
All business owners aren't feeling so confident these days, but one thing they seem sure of is that a recession is on the way. Our CNBC SurveyMonkey Small Business Confidence Index for Q2 found that 8 in 10 owners said they expect a recession will hit in 2022.
In America, we're seeing inflation out of control, with inflation hitting a 4-decade high. Even excluding the volatile food and energy sectors, we've seen huge spikes in airline tickets, hotel rooms, new cars, and rent, which keeps soaring higher. Inflation prior to April had 7 continuous months of relentless gains, placing huge pressure on normal American households. According to a report by Moody Analytics, US households are spending an extra $311 a month to purchase the same goods and services that they did a year prior. US consumer prices rose by more than forecast in April, indicating inflation will persist at elevated levels for longer and keeping the Federal Reserve on the path of aggressive interest rate hikes. The core consumer price index, which excludes food and energy, increased 0.6% from a month earlier and 6.2% from April 2021, according to the Labor Department. The broader CPI rose 0.3% from the prior month and 8.3% on an annual basis, a slight cooling but still among the highest readings in decades. In more shocking news, according to the National Federation of Independent Business, about 40% of US small businesses are planning on raising selling prices by 10% or more due to the 4-decade high inflation. The report states that many businesses are intending to increase prices above the current rate of national inflation. Price increases across the economy is putting a strain on American families. Americans are increasing their credit card spending and taking out fewer mortgages, as they simply must borrow to cover the higher costs of everyday essentials. It is estimated that a record 537 million credit card accounts were opened in the first quarter of this year, a jump of 31 million over the past year, according to the Federal Reserve of New York. A separate report last week showed US consumer borrowing soared in March by the most on record as credit card balances ballooned and non-revolving credit jumped, underscoring the combined impact of solid spending and rising prices. When it comes to housing, the rise of interest rates has forced fewer mortgage applications and refinancing. The data reflects a stark contrast from 2021, when Americans capitalized on some of the lowest interest rates ever to refinance debt at historic levels. As we have seen this year, the Federal Reserve has had to raise interest rates in their attempt to fight off inflation. Just recently, the Federal Reserve Bank raised interest rates by 0.5 percentage point, this being the most aggressive rate hike in 2 decades to fight against inflation. Moving alongside the rate hikes, the Fed has also suggested that it would begin reducing asset holdings on its $9 trillion balance sheet, much of which the Fed had been buying to keep interest rates low and money flowing through the economy during the COVID pandemic. However, now with prices surging at 4-decade highs, the Fed is being forced into rethinking its monetary policy direction. Jerome Powell warned just recently that getting this inflation under control would cause more economic pain. He stated that with a tight labour market pushing up wages, avoiding a recession that often follows these aggressive rate hikes would be a challenge. That it will be, according to many analysts, banks, and financial experts who fear of a major recession coming this year. Investment fund managers surveyed by Bank of America showed that global growth expectations plunged to a record low in April. Not only that, the same survey also showed profit expectations among investors had tumbled to its weakest levels since March 2020, and also closing on levels not seen since the 2008 collapse of Lehman Brothers and the 2001 dot-com bubble burst. One of the most concerning aspects of the US economy is its jobs market. Looking beyond the political rhetoric praising a strong labour force, it is clear that America's labour market is in big trouble. Amazon CFO told analysts on the company's earnings call that its warehouses have become overstaffed, following a large hiring spree during widespread lockdowns that drove consumers more and more to online shopping. Even retail brokerage firm Robinhood is cutting back staffing levels by 9%, citing duplicate roles and job functions after rapid expansion last year. Why are all these companies laying off people? The reason broadly being, business growth is slowing while labour costs are increasing. The combination is causing American companies across a variety of industries to slash headcount. Despite the obvious signs of a major recession coming to America, Joe Biden seems unfazed. President Joe Biden was not concerned regarding a potential recession in the immediate future, even after its worst GDP report in 2 years. Although originally not being concerned, he recently stated that he acknowledged that inflation is unacceptably high and maintained that lowering prices for American families was his first economic priority. Many disagree with Biden's remarks, stating that he was clueless in his quest to fight inflation.
My reaction, Liz, was more nonsense. This is the same lecture we got in the State of the Union when Joe Biden said the solution to inflation was, hey guys, just lower your costs. I mean, that's just a non sequitur. This guy is clueless when it comes to economics.
Despite what you think about the political actions being taken to fight inflation, it is clear that we're experiencing a very, very dangerous period in American history. There are signs that inflation will persist into the foreseeable future. Deep-seated trends in trade and demographics help keep inflation tame for decades. Now both are going in the opposite direction. Globalization seems to be going in the opposite direction in the past few months, with war making it worse. Additionally, the world's labour force has slowed significantly. It all adds up. Inflation will retreat from the 4-decade highs we're currently seeing as supply chain issues are resolved. Mark Carney, a Canadian economist, puts it as the long era of low inflation, suppressed volatility, and easy financial conditions is ending. In this new environment, borrowers from home buys to the US Treasury will have to pay more. There'll be fewer jobs in the workforce, as the Fed is forced to put a squeeze on labour markets. There'll be more risks for investors, as the Fed will be more concerned with cooling inflation than promoting economic growth. As for the average person, we can expect higher costs of living as financial freedom becomes more and more difficult for millions.